Welcome, gentlemen. So we're going to start with a blank slate. We've got no portfolio, and I want to start building one. I'll start with you, Rog. How do I go about? How do I start looking at stocks? What's the first step? What am I looking for?
Today or hypothetically?
You can do either or.
Okay.
You can work it together.
Okay.
You've done well.
Well, it's probably the same.
So what do you look for?
So three things. Quality, and there's a very specific way we have for defining that. Number two, value, and again, a very specific way of defining that. And number three, and probably the hardest part of the process, which is prospects. So we essentially want a very high quality business, so it has very attractive economics that are likely to be sustained. It's cheap relative to what we think it's worth, and it has great prospects for its product or service.
Okay, so do you talk to people like these gentlemen? Do you read the newspaper? Do you scroll through?
Okay.
Do you have filters? How do you get to that position?
Yeah,
that all
okay.
sounds nice, but I don't know how to find
Well,
it.
experience helps. So knowing, understanding the businesses that are listed in Australia helps. For example, out of the 1,800 odd companies, there's about 2,000 securities listed, but about 1,800 companies. And of those, fully 1,200 make no money. So that's very easy to get rid of those. And then from what remains, what we might do is look at things like return on equity. We look at margins, we look at sustainability of those margins, we look at changes in debt, changes in capital structure over time and how profitable those changes have been. And we use a quantitative approach to do that, and that narrows down our universe that we then through the research meeting or the investment committee meeting, primarily the research meeting, we then hand some of those companies that we haven't researched before to an analyst to go and review, and then they'll do what we call qualitative research and talk to management, talk to customers, talk to competitors, talk to consultants, for example, who've worked in the industry before, so we can get a picture of the industry, the competitive landscape and the prospects for that business.
Okay. Paul, you've got a bigger fish. You're looking around the world. Can you give us an answer to what we've just asked Rog? How do you actually identify companies, assets? How do you go in and find them, and then how do you make a decision to invest or not to invest?
Well, I think simplistically, the starting process is you're really just trying to look for the anomalies, because typically what we've found is when you get a subset of opportunities, throw them up on a sort of a risk-reward basis, you get the classic regression line appearing with about 80% of the stocks probably where they should be, and you really don't want to worry about those. You're really wanting to look what's really undervalued and what's overvalued. And so it's really, as I say, focusing on the anomalies, and then the process kicks in whereby you're trying to work out if they're genuinely an anomaly, because sometimes you do the work and you realise, no, they're really on the regression line. And that's just a combination of understanding how businesses work, understanding how markets behave, human nature, emotion, what drives valuation away from underlying business fundamentals. And then it's just the process, visiting management, visiting companies. Experience obviously helps because you've seen different businesses being valued at different points of time. And often it's as simple as seeing one business, say in the US, selling at 20 times and a business that is very similar in Europe selling at 10 times. And it looks like an obvious anomaly. So that's the start of the process. But there's no one equation to come up with an idea. There's many different ways to come across ideas. So you're using a multiple of filtering techniques, experience, as I said, is very important, and that's how it all starts.
But your investors pay you for a little bit of magic. What magic's that to make the right decision? Or is there human input and error?
Yeah, look, I don't think it's magic. The funny thing is when you look back over 30 years, the same things keep happening again. And typically it's a function that people start to over-exaggerate severe cyclical downturns and start to price them as being impermanent. That's usually where you get your best opportunities. And if you're willing to have a bit of patience, live with a bit of volatility at the bottom, sometimes live with a bit of ridicule, because if you want to be a successful investor, basically you have to be doing something very different from everyone else. And often at that key inflection point, you look like a real mug. But bottom line is that's when you find your best opportunities. So as I say, it's a combination of deep understanding of businesses, but typically the real trick or magic is simply arbitraging people's lack of patience and their emotions.
Okay, Steve, forager by name, forager by nature. You've got a big risk appetite when things get very bleak, such as in 2009. How do you get your investment ideas if you're going to be foraging? How do you know where to forage?
Yeah, I think you already heard from Roger and Paul. There's already two quite different approaches, and ours is different again. And I think as an investor, step one is to work out what you're good at, what you have the stomach for, and what type of business that you have an edge in looking at. And we buy lots of businesses that lots of people look at me and shake their heads and say, "What are you doing?" And they tend to be at that beaten up, unloved end of the market. You know, my constitution and my psychology is all about, okay, well, people are hammering this business and nobody wants to own it. That's the time we should be having a look. But we've built up a good record over the last 7 years of sorting out the ones that go broke from the ones that do turn around and become worth something. And that's not everyone's skill set. Some people are much better at finding businesses that can grow for a very long time than I am. So I think if you start with a clean slate, the first step is really to take a step back and try and work out what type of investor you are, what has worked for you over the past decade or decades that you say, okay, that's a space that I feel comfortable, and that's a space where I feel like I can do better than 9 in 10 people that are out there trying to do the same thing as me. And it's a question I constantly ask at work. If we like a stock, why is someone else selling it? And I think to think that you're going to outperform the market, you really need to understand what your edge is, rather than think that there's some golden rule that's going to make you money forever.
It's interesting you say the word crazy. That's what my kids said the other night. They asked me, "What have you invested in today, Dad?" And when I told them, they said, "You're crazy. Why would you invest in that?" So the audience is always at you. Talking about, let's go to a few scenarios. Stock you buy rallies hard. You've made a good investment. That's first scenario. What do you do with that stock? Second scenario is it's turned out wrong. Your thesis is wrong. The market's working against you. You're sitting on a loser. Can we go through each person? Steve, you go first. You're on a winner first and then a loser. How do you handle them?
I'll talk about a recent scenario for us because it ties into buying things that are beaten up and everyone hates. And we talked about it on an episode of Buy, Hold, Sell actually. But Whitehaven Coal was a stock in January that, you know, share price there $6 down to $1. We took a look down to 70 cents. We took another look down to 30 something cents, and we took a really deep breath. And it bounced really quickly after we bought it, which almost never happens to us. Most things keep going down rather than up, but it doubled in the space of 3 weeks. And I think, again, you've got to assess the situation. And in that situation for us, we'd looked at it at 70 something cents and said, we don't like the risk reward scenario here. Nothing had changed and it was back there. So it was time for us to take our money and run. We've owned another stock over the last year in ServiceStream that's gone up fourfold, and we haven't yet sold all of that position because we've constantly reassessed the value of the business and said, actually, this is going better than we thought. And then we've owned a stock, RNY Property Trust, that's dropped by 2/3 over the last year, and we quite clearly should have exited that position at a higher price and made a mistake in not doing so because the situation was changing and because some of the things that we thought were going to happen quite clearly weren't. And I don't think we changed our mind as much as we should have there. And it's a very difficult thing to do. I think if there's the liquidity in the stock and your investment case is not working out as you expected, sell it and come back to it. Don't justify the situation that you're in.
At a set price? Is there a stop loss if you've got liquidity?
I don't do stop losses. We've made most of our money out of stocks that have fallen after we first bought them, and we would have been stopped out of them if we'd had them. But we do. One thing we like to do is hand a stock over to someone different. You know, if someone's responsible for the idea in the portfolio and we've bought into it, hand it over to someone who has a little bit less of that baggage and say, okay, this thing's down 30%. Has it changed? Is the thesis still right? But try and assess it as objectively as possible.
Paul, both scenarios, upside, downside?
Yeah, so there's no magic equation that tells you when to buy and sell. And to be honest, some of my worst mistakes have been selling stocks that have gone up. Around about the TMT time, I sold one stock that had gone up 100%. I thought I was a genius. It kind of went, very, very quickly. It then proceeded to go up 400%. So, the reality is one of my biggest mistakes. And likewise, I think investors have all experienced something going wrong with their thought process, and then the stock comes down, and you think, oh well, I don't really want to sell it now. Maybe it'll bounce. Never bounces, keeps going down. So it's one of those things that you try to avoid over time, but the reality is here, 30 years down the track, you're still vulnerable to making those mistakes. But I think the crux of the matter comes down to your original investment thesis. If you've got a really tight thesis and you understand why you own that stock, over time, as circumstances change, and they will change, then you're in the proper position to really assess its valuation and whether you want to continue to hold it. And the reality of life is good ideas are really hard to find. So if you come across a genuine good idea, you want to keep it as long as possible. And so the temptation is always to try and rotate it into some other new idea. But the better strategy is to make sure, as long as it's providing a satisfactory rate of return, you continue to hold it.
But going the other way, the downside, we all fall in love at some stage. We don't always stay in love. So the story can change. Yep. Stop loss, I asked Steve that. Do you implement stop losses? How do you turn yourself around when you're so convinced on an idea, on your thesis?
Look, in the end, it comes down to how well you understand that stock, and when you bought the stock, did you put a proper framework as to how you think it should be valued, how the market will react to it, what you actually think it's worth. And that way you're more likely to pick up when things start to go wrong, and you're more likely to act rationally. The reality is, if you've only got part of the facts, that's when the emotion kicks in and you're likely to make a bad mistake, like continue to own it because you think it'll bounce or you think the market's got it wrong.
You're allowed to give us one example?
One example, wow. I think during the GFC, some of the banking stocks. We own a particular banking stock that's made an acquisition which we fundamentally thought was a dumb thing to do. It was value destructive. The stock fell very, very quickly, and we made the mistake basically that we thought the market had already reacted to it. The market's relatively efficient short term, and that didn't turn out to be the case. And you kind of got caught in that sort of death spiral where it kept going down, and you kept thinking, well, they've over-exaggerated.
It's going to bounce.
It's going to bounce, and they don't bounce. So, as we've all made that mistake. In terms of stop losses, I've never believed in stop losses. To me, that's a trading strategy. If you're a true investor, it's either going to give you a satisfactory long-term rate of return or it's not. And if it's not, you sell. If it is, you continue to own it.
Okay, Rog, upside scenario, downside, how do you handle them?
So for us, it's a little bit different. We have a very long-term perspective. So price doesn't inform our decision about whether it's a good quality business or not. And so we're not trading stocks, we're owning businesses. And so really, if the quality of the business deteriorates, its performance is deteriorating, then that's going to have an impact on the pace of increase of its future intrinsic value. If the prospects deteriorate, that's another reason for selling. We owned in 2013 and 2014, we owned Woolworths. We chatted with a guy named Paul Foley, who was the former CEO of Aldi for 23 years in the UK. And he told us with surgical precision precisely what Aldi does in every country it enters. And suffice to say, we panicked. And we thought that the long-term prospects for Woolworths would deteriorate permanently. And even though the price was at $33 or $34, we decided to sell. So
I might get Paul Foley to manage my money by the sounds of it.
Well, if you had a retail portfolio, there's probably no one better. And you just get him to invest in Aldi stores for you. So that's about the only thing that's going well. And so we know how businesses increase in value. It's very, very simple. If you think about a bank account that's got $10 million in it with a 20% interest rate, and if it pays all that interest out every single year, then you're going to earn $2 million a year. But in 10 years' time, it's still only got $10 million in it, and it's still only earning $2 million, and both will be eroded by inflation. You don't know what interest rates are going to be, so you don't know what it's worth in 10 years' time and whether or not you'll make money over that period of time. But if you've got a business that's got $10 million earning 20% return on equity, which is what the interest rate is equivalent to for a bank account, and it retains a proportion of that interest and compounds it, if it retains 100% of it, in 10 years' time you'll have $63 million in that bank account. In the meantime, the share price is going to do all sorts of things, and that's why I said at the start, we don't let the share price necessarily inform any introspection. So just because the share price has gone down, if we believe that compounding machine is still in place, then that could be an opportunity to buy more rather than change our view. So it's not the price, it's just the ability of that business to retain and compound those earnings in the future that ultimately determines whether or not our view is right or wrong. Now, we do get them wrong.
So when they turn the compounding machine off?
Yeah, and that
And you
happens.
turn up at work one
Yeah,
day and you say,
JB Hi-Fi at
"Where's the
300
compounding machine?"
stores or whatever it is. Yeah.
Yeah.
So
What do you do then?
Well, at that point, what tends to happen in Australia with management, because they're pretty crap at actually reinvesting capital in general. What they tend to do is when a business, and I mean that categorically, what they tend to do is they tend to want to grow, and there's blokes like us sitting down at meetings with them saying, right, how are you going to grow? And it might be that they can't grow. It might be that they don't have the skills to grow. It might be that they don't have the opportunity to grow anymore. So in actual fact, what they become is a bond, and they don't grow. But their LTIs are it's all incumbent on them to grow earnings per share or maintain return on equity on a growing capital base, and they can't do it. So what they do is they go and pay too much for an acquisition. So we get very nervous when businesses mature, and that's another reason for us to sell.
Okay.
Yeah.
Not sure whether I got the downside, but...
So on the downside, so the idea is that we're wrong.
You're wrong, yep.
We're wrong. We sell. And it doesn't really matter what the share price does. I learnt many, many years ago when I was working at BT that when you discover an error, you just get out straight away. You don't try and work your way out of it. You don't change your thesis or invent a new thesis hoping that it will get back to what you paid. You just exit and move on.
The joy of the share market. You get the chance most of the time
Indeed.
to exit,
Indeed.
which
And-
a lot of
and
other
on the-
businesses don't.
And on the subject of stop losses, we actually have done a lot of testing of algorithmic trading systems back in my life at BT and trading derivatives. And what we've learned is that there are various forms of stop losses that actually can improve the performance of those algorithmic trading systems, but often they don't beat just a buy and hold. If you compare the stop losses to just buying and holding, often that wins. So we don't use stop losses either.
Right. Well, if you're picking the right stocks, the stop losses shouldn't come in.
Correct.
Okay, so we've all been in trends. Trends are fantastic. We've had technology, we've had gold, we've had consumer goods, we've had trends everywhere, and they're like black holes. They go along and they suck everyone in over time. Steve, can you make money out of following trends, or should you be sceptical? Because everyone else will make money in the short term, invariably.
I'm better at working out what they're going to destroy than I am at working out which companies are going to prosper in that environment. And I think that is the number one distinction to draw as an investor, is there's a difference between industry growth and company growth. And the aged care sector is probably the best space for it for me. We had that boom running up to the financial crisis, but everyone was saying you can't go wrong, the ageing population, buy these aged care providers and you're going to make a fortune. And we ended up in a situation where the capacity there were no barriers to entry, lots of capacity, lots of money came into the space and it destroyed the returns. And then you look at a space like tobacco over the last 30 years, and there's been a lot of decline going on in that industry, but no new money coming into it and no advertising being spent, and the returns from owning some of those stocks, whether you do it for an ethical reason or not, the returns from owning the stocks have been very, very good. So for me, it is a factor that goes into the valuation of a stock. Do I think this industry is going to grow, and can the business grow within it? But it is not something, we don't start with the theme and then go and find the opportunity. In my experience, there's more money chasing the themes than there are at the other end of the spectrum.
Paul?
Yeah, well,
You like the black hole or you don't?
Well, I guess part of it comes down to your definition of a trend. But one of the areas we've made a lot of money over the last 15 years was simple observation that Budweiser was selling at 20 times in the US, and Heineken, one of the great global brands of the world, was selling at 10 times in Europe. And we also observed that there was a Brazilian brewer who had like 90% market share, wanted to diversify out of Brazil, consolidate the global beer industry. So basically we were perceiving that there was going to be this global industry trend amongst the brewers. And so one simple idea that started with Heineken turned into 15 different brewing investments over the next 15 years. One simple idea, many iterations, as they slowly gobbled up the industry. And you would have seen recently that Anheuser-Busch took over SAB. And 15 years ago when we wrote our reports, we actually said it will come to an end when Anheuser-Busch takes over SAB. And as
the trend is over.
The trend's over. And so we still own Heineken, but it's the last of our brewing stocks. So I think when you actually sit back and try and look at those genuine long-term valuation anomalies, you can spot trends. And the benefit of that is you don't have to come up with any new ideas. You just keep playing. It was like the commodities in 2000, 2001. At the bottom of the commodities cycle, the small cap Australian commodities were actually making money because their currency was so low. And it became pretty obvious they were going to be gobbled up by the big guys. So what happened is the medium guys took over the small guys, and when they gobbled up, the big guys come and took over the MIMs and the Western miners. So again, you had a sort of a 7 or 8 year trend. Obviously, China came through and helped that dramatically. But you had a 7 or 8 year trend where you could just make money out of replaying the same idea over and over again. So they can be...
On the beer trend, you gave us the final date. But with something like a mining trend, when is everyone sucked into that black hole, and when do you know when to get out?
That's hard. We basically, again, we thought when BHP takes over Western Mining, that would be the end of it. And so that's when we actually exited. And I think what happened is it went up, and then you had the GFC, and then you had the big boom again. Now, the interesting thing is when you actually look back today, 2008 actually was pretty close to the top. But definitely, in the short term, it looked as though we left a lot of money on the table. But we did pretty well out from 2000 to 2008. And sometimes you've got to let other people make money because you'll never pick the end of it. Because again, by definition, the peak is when all the consensus has basically been sucked in. And if you think you can time getting out ahead of them, good luck. I mean, I just haven't found too many people that are very good at that.
Just butt in really quickly there, Paul. There's a lot of that going on in the healthcare space at the moment. Is it a trend that you see reaching a climax like that at some point down the track where we end up with 3 or 4 global healthcare players or even less?
When you say healthcare, you're talking pharmaceutical, you're talking
I'm
more
actually
the
talking about that hospital space and the service players, yeah.
Yeah, look, it's a hard one. It's not an area that I know that well. But I think what's happening at the moment where people are going to be very careful is a lot of these trends at the moment are being driven by the fact that long-term bond rates are the lowest they've been in the history of financial markets. So I personally think that trend's somewhere near an end if it hasn't ended already. And the hard part is trying to work out, do we go through a long period where we just have these low rates and then at some point down the track, everyone gets what they wish for, inflation, and then we have some trouble in financial markets? Or will it come sooner? How will it impact the valuations? I think you made the point, in a zero interest rate world, I mean, something like a Visa or a Google at a high growth, they're probably worth 100 times. Mm-hmm. So we're all battling with, what are stocks really worth under this current scenario? But my personal view is, this is why the property market's so dangerous, and I suspect healthcare is considered a long-term duration asset, and so therefore bond rates are helping it. But my personal view is that things have been driven. We've seen rates, I think 20 years ago, 15, 16% for 10-year US government bonds. They're now 1 or 2. It's sucked a lot of money into the wrong areas. There's been a lot of misallocation of capital. And it goes back to Peter Lynch's famous quote about you have to look forward, not back. And he said, the day after the market crashed in October 1987, people began to worry that the market was going to crash. And I think there's a big danger at the moment that people have become so used to declining bond yields and low bond yields that they're making some major investment mistakes.
And the volatility is something that Paul's getting at. My first job was at Macquarie building infrastructure models, and we did Sydney Airport, and we had a very savvy investor co-investing with us from the Ontario Teachers Pension Plan, and I was building the model, and we had a discount rate of 10% and a growth rate of 8% for a very long time, and that spits you out a very, very high multiple in terms of what you can pay for that airport 50 times. And the guy says to me, well, change that rate from 8 to 6 and see what happens. And all of a sudden your valuation halves for an asset like that. And whilst that's a high growth rate, close to discount rate problem, we're getting the same issue now just because of very, very low discount rates. You start substituting a 4 for a 3 and you're having a very big impact on valuation. That's been a big tailwind for the last few years, but it can be a massive headwind when it turns and goes the other way. It can mean dramatic changes in asset prices.
Rog, I've never had a conversation where you probably said the least, but we're going to give you.
Having a good go.
Yeah, he is. We'll ignore him for a sec. We're going to give you a chance to come back in. Now we've only got about a minute each, but give us a rule. What's the main rule about investing when you're dealing with the share market and you're dealing at the risk end of the curve, which is equities?
The price has to be below the value before you buy it. the higher the price you pay, the lower the return you're going to receive. And everyone's talking about low interest rates now. Everyone's talking about the fact that, that we back in 1981, you had half the debt that corporate United States has today. You had stocks trading on a PE of 7, and you had this long-run credit-fueled growth ahead, as well as productivity improvements. That was a really good time to invest. Now you've got the opposite, and stocks are trading at 18 times. How can that also be an attractive time to invest? So when interest rates are at 0, people talk about something being worth 100 times. That's just what other people are willing to pay. We're not willing to pay that because our first priority is to protect investors' money, and I don't believe historically there's ever been a time where paying 100 times for something's actually worked out. So we don't.
Okay, thank you. Paul, the golden rule?
Golden rule, one rule. Never let the market make you do something you don't want to do. And what I mean by that is never let your investment decisions be based on external influences. You've got to back your, obviously you've got to do the work, but you've got to back your own judgments, your own convictions, because the greatest investment opportunities I've found over time at that key point of inflection, as I said before, people were not only questioning you, in some cases they were ridiculing you, throwing the old rotten tomatoes. And if you react to external influences, you'll walk away right at the time that you have to have your most conviction and what will clearly dictate some really good returns for you. And markets are very, very tough, so when you come across those ideas, you've got to stick with them.
Okay, Steve, here you go again. Golden rule?
Stay within your circle of competence. You can break a lot of rules if you're very, very good at a small number of things. You look at Steve Smith playing cricket and he breaks almost every rule of batting that my father would have taught me when I was a kid, and he scores a truckload of runs because he knows what he does well and he sticks to it.
Okay, terrific. All right, so what we're going to do now is open it to questions. I'll just kick off with one while people work out if they want to ask something of the panel. Maybe, Roger, we can ask you this. We seem to hear a lot about buying quality companies. How do you differentiate between a good company and a company that makes a good investment?
I think they're the same thing.
So there's not a price for everything?
So no, there are thousands of ways to make money in the stock market, and you've heard 3 different techniques enunciated today. Our particular way of doing it is that we think they're both the same thing. You can approach the stock market as a venue to bet on up and down, and for us that's tantamount to betting on black or red at the casino. Or you can approach the stock market as a venue where you can buy outstanding companies and businesses. As I said earlier, we understand how businesses increase in value, and whether they're listed or not, they increase in value the same way. And over time, we know that in the long run, the market does a very good job of reflecting the increase in value. So they're the same thing. A good business is a good investment, provided you're not overpaying for it.
Okay, so price does come into it. Okay, have we got any questions? Gentlemen here, and please direct it at the panel or an individual, thanks.
Well, you mentioned right at the opening of this session of, let's suppose a scenario where you just landed on the planet and you have nothing, so you're starting from 0. We didn't kind of get to that. Given some of the comments that all the panel have made, including Roger at the end there, that the scenario today, multiples and everything, in the macro picture that we've heard about, compared with a few years ago, is very different. Where would you go, and what sort of markets and what sort of assets and what sort of industries perhaps do you look at if you're starting from 0?
Today?
Yeah.
And who would you like to, do we go with Paul?
All of the above.
Paul, you got to...
Yeah, look, I think you've got to start off with a framework of what your expectations are, because the reality of life is nominal returns are going to be lower going forward. And, we've got 2% bonds, we've got low inflation, we've got ageing demographics. So as long as your expectations are realistic, the reality is businesses today are providing a pretty good return in relation to bonds or other asset classes. So clearly they've re-rated, but I think if you're very, very selective, there are opportunities out there. In terms of specific opportunities, one we think is interesting at the moment is the European banking stocks. And when I talk banking, I talk the domestic banks that dominate their market, the CBA equivalents, because basically they're going through a long-term trend, or whatever you want to call it, where they're starting to increase their payout ratios, because in a low-growth environment, once you've got your capital in order, you pay out high dividend yields. And we saw what happened in the Australian banking stocks from 1994 to 2014, where people began to realise the value of high dividends. So that's one area that I think looks interesting, but there's a number of different stock opportunities out there, but you do have to be probably a lot more patient going forward than, the last 5 years has been a golden period because it was very, very depressed, and now it's re-rated. Having said that, one area I would avoid is anything property related. Personally, I think it's absolutely crazy, and I think, it's purely driven by long-term interest rates. It's a long duration asset, but I think it's quite scary what's going on in some of the property markets around the world. And to be honest, that is a bit of an outlier risk to me in terms of what happens going forward.
Do you include Australia in that? Because
Australia's the worst.
the worst.
It's unbelievable, and it's just the old sheep mentality because they've had a great experience. I mean, I would have told you this last year and the year before, but it's just got even more overvalued. But one benefit of running a global fund is you do visit all these cities around the world, and you just often on the weekend we'll just go and see the latest apartment up for sale in New York, London, wherever you're going, and the price per square metre for apartments in Sydney relative to the rest of the world is just ludicrous. So I'm kind of scratching my head, to be honest, but I think it's a huge anomaly. And you've got to ask yourself the question, maybe rates will stay here for the next 5 years. Under that scenario, I still don't think property prices can go up. But if rates go back to 3 or 4 or 5%, property markets are in big trouble. And when I came through uni, I think we had someone come and present to us about the overnight cash rate in the money market being greater than 100%, and home loan rates were like 18%. So it's like it has come a long way. So I think property's a disaster waiting to happen.
Mm-hmm. And even if rates stay where they are at the moment and we go into a deflationary environment, which I don't think is a certainty, but it's a possibility, having a 90% LVR on a home that is in a deflationary environment is going to be a disaster for a lot of Australian investors.
We've seen that in Japan.
Exactly.
Yeah, okay. All right, next question. Anyone like to? Gentleman in the front? In the middle in the front?
My question's to Roger. You said you'd sell when a particular stock falls. So what percentage fall do you require to trigger your selling? And for the other panel members, is there any particular percentage fall that causes you to become alarmed?
I don't recall saying that.
No, but you can.
But I'll pretend I did.
Yeah.
Yeah. I definitely did not say that. And in fact, I specifically said price doesn't inform our decision. So it's not the stock price that informs the decision. We don't have a limit for the price falling. We are informed when the price changes relative to our estimate of value of that business, but by itself the price change doesn't tell us anything. So if, for example, the price goes well above what we think that business might be worth, maybe 20% or 30% over, we would certainly consider very carefully reducing our position in that unless we believed that its prospects were so entrenched, or its bright prospects were so entrenched that value was going to continue rising, and we may continue to hold it. So that's the only time price would, when it's well above our intrinsic value, we might consider selling. But price by itself doesn't inform the decision. No, if you've got a business that's rubbish, whose prospects are deteriorating, Woolworths, for example, what's the price? It's not a blue chip anymore. What's the price of that business that's the right price to pay? Whatever price you pay for it, it may arguably be very expensive because in the future its margins are going to contract even more. What are its options in the face of Aldi? One is to reduce its line and become more efficient. Then it's just like Aldi but without the efficiencies of systems that Aldi has. The alternative is reduce prices, reduce margins. Where does that actually stop? Well, Aldi operates profitably around the world at a 2.5% EBIT margin, and Woolworths was sitting on 8% only 2 or 3 years ago. So it's a long way down before you reach the bottom. And let's suppose you buy it and it goes down. Well, what's the right, where were you wrong? I don't get that. So it's not the price that determines the quality of the investment, it's the quality of the business first that determines the quality of the investment.
Paul, you got any comments? You said you don't have a stop loss.
No, well, I think my comment would be one of the biggest mistakes investors make is they associate price action with business fundamentals or business value, and there's just absolutely no correlation between the two.
In the short term?
In the short term, yeah. Price action's just more a reflection of people's emotion. So it's a hard one because, again, stock prices typically go down after you buy them. The really good investments that you make, they typically go down first because it's so hard to pick the bottom and people are being so hysterical that they typically always go down more than you think. On the other hand, sometimes you walk in and there's a news announcement and the stock's down 20% and it's like, it's already, the horse is either bolted, but that's when you've got to reassess, the reasons for owning that stock, and it might be then that the correct decision is to sell, irrespective of that 20% decline, or the decision might be to buy more.
Do you feel sick at that stage? I've had that experience.
Well, I was actually going to say, I don't know about, I suspect it's true for all fund managers, but most fund managers, if you walk in the office and your stock's down 1%, you feel sick. When it's down 20, you want to cut your wrists, and that's why markets are so emotional, it's like, and that's why you got to guard against that. So, I think as fund managers, we have a bias when things go down, we really do feel poorly about it, and yet when things go up, it's like it's just business as usual. It's not an even distribution. So, but it's hard to say. Depending on market moods, it could be a 5% mood, it could be a 10% mood, but as Roger said, it comes down to assessing the business value, and if the price of the stock is far enough below that inherent business value that you're going to make a satisfactory return, that should be what you base your decision on.
Steve, you want to chip in there, or you think you've covered?
Happy with all that.
Happy with all that. This gentleman asked me before, so I'll chip in as well. I'm the opposite to the other guys on the panel. I'm a seller. I love selling. I don't like owning anything. I'm one of the lucky people in the world who's got one of Paul's expensive houses in Sydney, and I come home every night and say, will I ever be able to sell this when the day of reckoning comes? But with the stock market, it's a joyous occasion because it lets you sell most of the time. So I tend to be at 10 to 15%. Because I look at a lot of businesses, and to claim that I understand them thoroughly is a gross exaggeration of my knowledge and ability. So I'll sit on the sideline and watch it unfold, and there might be a better price point down the track. So I'm probably a bit different to the other guys. We've got time for one more question over here.
My question is to Paul, just following on from your comments on property. Just your thinking around the banks. And then from there, just following on, just the Australian market's obviously so narrow, and you've seen people piling into the likes of Sydney and Transurban, arguably great assets, but what value on those stocks?
Yeah, I guess, well, banks are an interesting one when it comes to property because clearly 60% of their assets are effectively home loans. And I guess it's one of the debates that all the banking analysts are having at the moment because people underestimate the leverage in the bank balance sheets to residential mortgages. They kind of feel safe because the capital ratios are quite high, but with the risk ratings, they underestimate the fact that they're gearing up those home loans quite significantly. So, in Australia, I think as an investment, residential property is going to be a lousy investment from here on. I think I'm not that concerned about the impact it has on the Australian banks, other than it makes it hard for them to kind of grow their loans, because Australians will fight to pay off their home loan for if it's the last cent they've got, they're going to put it against their home loan. So I suspect we're going to get a slow deflation in property prices, and therefore it's not going to really hurt the banks. And the banks have already come off recognising that tail risk event possibility. And so the reality is you're now getting, on a grossed up basis, 7, 8, 9% dividend yields, which in a low inflation and low bond rate environment is actually quite good. Even if the stock prices stay flat for the next 10 years, it'll actually be a pretty good return. So, but if you think we're going to have a California type housing crisis, you don't want to own Australian banks. They're in serious trouble. Now, I don't think that's going to happen, but so we're actually been recently buying some of the Australian banks. In terms of Transurban and those sort of assets, they're the major beneficiaries of these sort of low interest rates because you bang them into the equations and anyone can kind of work out high quality business, low discount rate's going to be very, very valuable. The problem I struggle with is, again, I look back, if we've got the lowest interest rates in the history of the world, that's not a normal event. That's a very extreme event. So I don't know when it's going to change. All I know is it probably will change. And therefore, I just want to be very, very cautious about those sort of assets that the discount rates heavily influences and make sure that I really want to own them. Now, I could be wrong on interest rates. They stay here for the next 20 years, in which case they'll continue to be good investments. But it's funny when you go back to when interest rates are very high and inflation was very, very high, and someone had told you that you could sell Italian government bonds at a negative interest rate, they would have locked you up in the asylum. But the authorities did everything they could to break the back of inflation, and they succeeded. Now everyone wants to break the back of disinflation, and my suspicion is that sometime down the track they're going to succeed, and then it's going to have a negative impact on those sort of assets.
Just to finish on Steve, 30 seconds. Do you like the banks? I mean, it's a pretty prominent question for the audience. The Aussie banks here.
No, I don't. I'm as concerned as Paul is about the resi property market. I see plenty of ways that they may muddle through that, but I think it's going to be a long-term difficult environment for them. And the tail risk for me is some of these cultural issues in the banks. Paul was talking about the global perspective. We've owned Lloyds for a number of years, and every time that company reports, there's a new provision for billions of pounds that they're paying out to customers for mis-selling products over the past 10 years. And I sit there and look at some of the stuff that the banks have been up to for the past 10 years here in Australia, and it worries me quite a bit in terms of the repercussions for shareholders of that. And I haven't yet seen the language and the admission from the businesses themselves that they really genuinely want to fix this. There was a big interview in Boss magazine with the 4 chairmen of the Australian banks a couple of weeks ago, and the language was very much there's a few bad apples in the barrel, and I think that they have a remuneration structure and a problem that is very significant.
Okay, Rod, you got 15 seconds. Banks, yes or no?
15 seconds.
As
Okay,
a sector.
so let's put aside property. We've had a really well publicised view on property in Sydney, and it's not promising. But in the absence of that, the fact that the bank's CET1 ratios were forced to be increased by APRA, so the Common Equity Tier 1 ratios have been increased, and the mortgage risk weighting ratios also have been forced to increase. It means that they need more capital, and for every dollar of capital that they've got, they can't lend as much. So that limits their prospects going forward. Their credit growth obviously also is diminished, and that means that their intrinsic value won't grow at the same rate as it has in the past.
Terrific. Okay, I'd like to thank Roger, Paul and Steve. Everyone give them a round of applause. Thank you very much, gentlemen.